So we talk about long-term moving averages, by the way. That's what those ribbons are. Remember how I was talking about the 200 period takes a long time to show you the average of 200 candles past price
Yeah.
action. So this is it, right? You could see price action's way down here, and this thing, regardless of the time frame that it's analyzing, um, it's kind of like saying, or what I would tell you is any long-term moving average, by the time it's here, it's taking into account, like, I don't know how many, but 200, uh, in this case, 200 times 3, right? So it's taking into account like 600 days of price action for it to say this is the average price over 600 days of time. And so if the average price is here and it's way down here, some people might at least start to look and evaluate that for a potential buy. And so then you say, like, but how do I know when to buy? And that's where the algos kind of come into play, at a really, in a really nice way. If you have, and I was talking to Markel about this just earlier today, if you have a fundamental reason to believe that an asset is going to be a success in the long term, and you have maybe public sentiment that says the market is good for crypto or for tech stocks or whatever it is, and you feel good about like a few of the different reasons, then the algos kind of help the technical analysis side of things, because we wouldn't know much about much. We would just say, man, even here, it's way below the long-term, price action moving average. And so how would I know that this isn't the spot? Well, like I said, a big part of what I've been working on is avoiding, market fake outs, like trying to at least do our best to avoid dumb things. And so if we look at it and we kind of dissect it, we'd say, well, on the 3-day time frame, the movement monitor never turned orange. So the only prerequisite we met out of even our 3 that we were using a few months ago, the only one we really met was the volatility cloud turned green. So at best, though, we had orange on red on green. And so even using kind of like our old school way of doing things, this would have probably been relatively easy to avoid, simply because the movement monitor never turned orange. So then it keeps going, right? Let's just pretend we're evaluating this asset. It keeps falling, keeps falling. How do I know when to pay attention to this asset? And so for us, and the whole point, of algos and alerts and time efficiency and all the things that we're like doing our best to create, right? Statistical advantage, all of those things. The cool thing about it is, you have the ability to set an alert just for an orange breakout bar showing up on as closed, or even just as pinging or flashing for the first time on a 3-day time frame. But that doesn't bring a lot of certainty, right? Because we've seen that before. So when I'm looking for deviation from, a pattern that has existed, and I say, man, I really need something that shows me there's some sort of deviation that says I have a reason, a new reason that I haven't seen in a really long time to go bullish on something, then I want more certainty, even if I have to pay a bit more for that certainty. And so what we would find is that orange on green occurred somewhere in here, right? One of these two. Let's see. We'll break it down. We'll really like see which one it was. And I'm gonna actually get rid of those, because as I manipulate the chart, those get less relevant. When did it actually turn? So when it actually would have pinged me for orange closed, actually happened to coincide with when we had the expansion monitor pinging, right? The first green dot happened to be the very first day that the movement monitor on this particular time frame, the 3-day, turned orange. And so that is actually when, even if I didn't have the price action pulled up, let me see, I'm going to use this one here, that is actually when this candle, whatever that price action is in there, this candle is literally like the candle, the one that's going to be right in the middle of that green rectangle, is actually the candle that would have pinged once it was closed as having orange on orange over green, now with our current algos with expansion, right? So now it pings when not just one of those conditions are met, not just the movement monitor itself, but with expansion. And so that's when we would not waste our time even looking at this thing until that day. And so now we can kind of see where it was. And so we'd say, okay, it's right there. That is the day that I might look for. That's my trigger day. And so somebody could literally jump in and just choose, because that's a nice strong trigger and it's very much a deviation. So somebody could literally choose to do something like this and say, man, it's a 3-day ping. I think this could be the one that sends it up. But they'd have to ask themselves, can I at least get something like this where I can get 5 units of reward for every unit of risk I take? So if my risk is 14% that I stand to lose with this particular evaluation, then that means, my gain here is 72. And when you just kind of do the math on those numbers and you just divide one into the other, it's 5.12. And that is Paul Tudor Jones' kind of like standard of risk reward ratio that he thinks is good, probably for non-leveraged positions, right? So if he's just buying an investment and he's trading it, this is kind of what he looks for, and he's very open about it. He also says that he only likes to look at assets that are operating up. Like if he's going to buy an asset, he says he only likes to buy assets that are operating above the 200-day moving average. So just kind of a couple things on him and where I kind of got some of the logic for some of, what our strategies are. So, so as I look at those things, that is where a person gets to decide if they want to do something like that. And so this is here because this is literally when this one closed, right? It closed right here at $6.23. And so it's saying I could have literally just jumped right in because it closed. And if I did, what would make sense for my stop loss? Maybe that volatility line, maybe the movement monitor just below it. And then I'd ask myself, am I really willing to invest in this thing and possibly lose 17%, possibly lose 13%? It might not be bad if you really think it's going to go up here, which, is possible. If you had a reason to believe, and if the conditions conducive monitor was looking good, but you'd want to, in our world, you'd want to collapse that risk as soon as possible, which in the case of this volatility cloud, which was climbing, right? You can see that this cloud was climbing. So in the case of this particular situation, you kind of took a bit of a risk these 2 days. And by the time it was on this day, that volatility cloud had actually climbed to a place where, I'm going to move this out of the way so you can just see the cloud itself. You can see that cloud itself climbed to a place where technically you could remove the risk. And you can say, now my new stop loss is literally like, 2.5% from price. So now I stand to lose a lot less. So I jumped in because the volatility cloud was kind of climbing, which is usually bullish when you see it rising. When it's flat, it's kind of either consolidating and just kind of flattening out, or it's potentially even reversing in some cases. But sometimes it goes flat and it continues to climb. And so this was a little risky because it was under this long-term moving average. But this is where I usually would tell people to find some perspective on a different time frame. And so what you could do is you could say, if I know that was kind of where I'm looking at making my move, right? My alarm just went off right at that line. And I don't have to do something within seconds or minutes or even, probably hours. I probably have at least hours to make this decision. If I know this is the case, where are we relative to Paul Tudor Jones, thoughts, right? Where are we relative to his thesis on the 200 day moving average being important, right? Like his thought process is that's important. You shouldn't jump into anything unless it's above the 200 day. So if I'm investing in something and I want to like listen to some of his logic or at least think it through, then that becomes important. And so I drew that line because that line gave me perspective from the entry alert, like when I got that ping that I had orange on green with the expansion detector also pinging. This is where it was. If I was only paying attention to the 1 day, it would have been a bit earlier, but it's a bit more dangerous, right? The 3 day is going to be potential for a much larger move, especially because it hadn't been bullish in quite some time. And so if I know that this is exactly where that 3 day candle closed when I got my ping to possibly go long, I ask myself, am I above the 200 day moving average ribbon? And so the answer is yes. Like I want to check to make sure I'm not doing anything dumb. And so getting perspective from a couple different time frames is super valuable. And I'm going to show you an easier way to do this too. I'm explaining it thoroughly, but I'll also show you some charts that I built for you that'll make this whole thing easier. So you're using the 3 day data to kind of be your trigger. You're using the 3 day data, and then you can see how overall accurate this 1 day volatility cloud was too, and how many entries it kind of gave you. Right? Like in hindsight, we can see how good it was. Like as far as like entering right next to the volatility cloud, there were 2 here. Maybe this one could be considered one. There was clearly one here that was like super precise. A couple down here, there was one here. So this one has served really well for using it as a support, right? Possibly used as an entry if you wanted a tighter stop loss, if you didn't want to risk whatever it was, right? 15%. If you wanted to try to risk less, smaller time frames and zeroing in on, ideas for how to get a better entry are, probably more often going to be found in smaller time frames. But in the scope of this big move, you probably wouldn't want to go too small. You'd probably just want to like consider the 1 day, if the 1 day has quite a few opportunities, that's great. Because by the time that ping went off, which was like right in here somewhere, I mean, we drew the rectangle, right? So that gives you perspective on when that 3 day ping went off. So by here, it had already occurred. And here's another opportunity for where you could have gotten in. Right, let me erase some of this because it gets cluttered. But if we know
that's like
right
how
here,
how many days is that? That's just like a week, isn't it?
yeah. So you literally
That's like every day.
You would have gotten alerted, and that's what I'm saying. Like we don't have to have as much FOMO or move as fast as people think we do. A lot of times, it's just, and I was saying this earlier. It really is. If in business, the person who cares the least often wins negotiations, then the same kind of applies to trading. Like the person who cares the least as to whether or not they jump into the position or even if it takes off without them, the person who knows that there's an opportunity of a lifetime, once a week or maybe once every day, and it's just a matter of sitting down and doing some things and hitting them every so often. That person doesn't care. And so your alarm would go off inside of this rectangle, right? Time frame wise, you would have got that ping that says, hey, on the 3 day candle, we're bullish. We have orange on green with expansion. Then you'd go to this chart and you'd say, okay, cool. I want to find an entry. So here's phase 2, right? You have the trigger go off, which is phase 1. Phase 2 is finding an intelligent entry. Because we can have the trigger go off and price could be way up here. It doesn't mean we jump in right away. It just means now conditions actually are favorable where I'm committed to if I can get a good entry, I'm committed to longing this asset. And now I'm going to look for the long. The trigger gave me kind of like my permission to look for the long. But it doesn't mean I FOMO into price action wherever it's at. It means that I look for the best possible place to long this asset. And so that is a thing that there are many different, ways to evaluate. But all I would say here is, as we look at the 1 day and we say, how does it look on the 1 day? We can go, wow, the 1 day has been in expansion for quite some time. The 1 day is riding an orange movement monitor, which is great. At the time that the ping happened, which is the day after this green rectangle, the price action was above the 200-day moving average. It's above the 21-day exponential moving average, which is the white line, which moves a lot faster than this one, right? This one moves super, super slow, like 10 times slower. And this one technically moves like 10 plus times faster. And so it's much more reactive to what's really happening, which is why it's much closer to price, while this one is just going slow. And by the time it's like over here, it's finally reacting to price a little more violently, because this is probably a reflection of this, you know?
That it was
Um,
a precursor.
yeah, so it's kind of saying, oh, like, hey, I guess I should wake up and move. Like, looks like I'm behind. And so it's kind of catching up. And the more violent the price action, the more this thing moves more abruptly, because it is kind of tracking the average. And so it did kind of go parabolic over here, relatively speaking. And so this is just kind of to say that that's when it went off. That's the trigger. I'm just using that word. And then